Launching a new currency for a large economic area is an extraordinary event in the history of monetary economics. The euro area certainly qualifies as large in economic size, as measured by GDP, in population size, hundreds of millions of people, and in political configuration, as it encompasses many nation-states with diverse languages and cultures. History will show the introduction of the euro as a grand and unique experiment in monetary economics. Euro-skeptics existed before the actual launch of the currency. The doubters cited a multitude of reasons why this grand experiment would fail. So far, however, the result has been success, and the world is witnessing the emergence of a strong, reliable, and viable reserve currency. This chapter offers some observations about that evolution and opinions about its continued favorable prospects. Creation of the euro and transfer of currencies. Getting to a single currency in Europe was a century-long task that first required several catastrophes. One could argue that it started with the collapse of Tsarist Russia, coincident with World War I. This led to the division of Eastern and Western Europe. The Weimar Republic's hyperinflation and subsequent demise led to the rise of Nazism. From the final chapters of World War II came the subsequent global dominance by the United States. The largesse of the United States, with the Marshall Plan and the rebuilding of Europe, was followed by 4 decades of internal European dialogue. 1992 was a special year. The Treaty of Maastricht, signed on February 7, 1992, was coincident with the peaceful emergence of an independent Central Europe and the demise of communist USSR domination. European countries decided to formally set aside war and to coalesce toward a single economic unit. In 1991, they seriously started the contractual attempt to achieve a single currency. After 1,000 years of enmity, France and Germany engaged in true rapprochement. The 1992 Maastricht Treaty set the Eurozone admission criteria regarding national budget deficits and actual rates of inflation. The goal of this new hard currency was to be dependable and reliable. The condition that the currency could not be manipulated by a single national government led the target list of accomplishments. Devaluation as a single country option was eliminated. The new euro was to be inflation-proof. The Maastricht Treaty required ratification by its members. That process took place in the decade of the 1990s. The final formulas and currency exchange rates among the original 11 members of the Eurozone were not completed until the end of that decade, in 1998. Of the original 15 countries that determined to form a European Economic Community, to be named the European Union, EU, only the UK, Denmark, and Sweden decided not to join the currency union. On January 1, 1999, the virtual euro began to trade in 11 countries. It was an immediate success. As agreed, 3 years later, on January 1, 2002, the paper euro replaced the national currencies of the then 12 countries. The European Central Bank, ECB, was born. It was charged with the responsibility of maintaining price stability, which it defined as an annual inflation rate of under but close to 2% in the medium term. It is an independent, separate body above the political power of any single national government. It has its own governing council. The terms of its construction are defined in a treaty to which Eurozone countries subscribed. Only unanimous consent can change those terms. The early stages of the euro, see Figure 1.1, showed a rapid decline in value against the dollar. From its January 1, 1999 opening price of $1.17 to its low of 84 cents, the euro seemed to be a candidate for freefall. Euro-skeptics had many reasons for claiming the euro would not succeed and that the experiment in monetary union would fail.